There is a remarkably simple, yet overwhelmingly overlooked tax-optimizing financial strategy that most Canadian retirees unfortunately never learn about. Discovering this one technique can fundamentally reshape your entire financial future, potentially saving you tens of thousands, and in some more substantial cases, hundreds of thousands of dollars over the course of your retirement years. To be perfectly clear, this is not about some complex legal loophole, nor is it about taking on risky investments. It isn't complicated in its essence. It boils down to being able to answer one critical and decisive question: which specific investment account are you drawing your money from, and precisely why are you choosing that one over the others? Astonishingly, despite the high stakes involved, most Canadians approach this crucial decision entirely backwards, often purely out of convenience. And tragically, the immediate cost of making this significant error isn't obvious. It doesn't appear as a single, devastating bill. Instead, the damaging effect of this approach shows up slowly, relentlessly, and with increasing impact year after year. It manifests in much higher tax bills than necessary, the completely avoidable loss of critical old age security, OAS, benefits through clawbacks, and ultimately, a significantly smaller estate value being left behind for your beloved family members. In the end, after 13 dedicated years of helping thousands of Canadians successfully retire and achieve financial peace of mind, I want to show you the specific, proven moves that I diligently make with my clients, the highly effective, step-by-step financial adjustments that practically nobody else is walking you through with this level of clarity and precision. The reason this matters so much cannot be overstated. The way you pull money from your savings significantly dictates how much of that hard-earned savings you actually get to keep, and how much you will be forced to hand over to the government in the form of completely avoidable taxes. Let's dive deep into the first critical strategy, the tax bracket filling strategy. Most Canadians unfortunately think about retirement withdrawals purely as a method for spending money. If they need $3,500 this specific month, they simply take $3,500 out, and they do so from whichever account seems easiest or most accessible at that particular moment, often their registered retired income fund, RRIF, or perhaps their non-registered account. This seemingly innocuous approach is actually comparable to filling your economy car with premium gas, when regular unleaded is right there at the same pump for a much lower price. You are essentially paying significantly more than you need to for the exact same result. The retirees I work with who pay the absolute least amount in taxes are not utilizing any fancy or aggressive tax shelters, nor are they doing anything complex. They are simply filling up their lower tax brackets deliberately, proactively, and with careful planning, instead of accidentally letting those low-income years go to waste, or waiting until their RRIF minimums skyrocket. The most effective tax planning involves looking at your current taxable income and maximizing your lower-tier tax brackets. Consider the example of Gloria. At 66, she is single, living in Ontario, and just converted her Registered Retirement Savings Plan, RRSP, into a Registered Retirement Income Fund, RRIF. She has $340,000 in her RRIF and $60,000 in her tax-free savings account, TFSA. She's collecting CPP of a little over $900 a month and full OAS, which brings her guaranteed government income to roughly $22,000 per year. The first set of combined provincial and federal tax brackets in Ontario goes up to approximately $58,523. Given Gloria's existing government income of $22,000, that means she has about $36,000 of available room in that first set of low-tax brackets before any additional income would jump up to the next, much higher tax bracket. Most people in Gloria's exact position would simply take the required RRIF minimum withdrawal, which at her age is about $14,800, and they would feel great about it, thinking they kept their income and thus their tax bill low. By taking that approach, her total taxable income would be around $37,000, and her current tax bill would indeed be very low. However, here is what I would strongly advise Gloria to do instead. Based on a forward-looking, multi-year plan, I would have Gloria withdraw $30,000 from her RRIF, not just the mandatory $14,800. Why would I recommend paying tax on more money than she needs to spend? Because that $30,000 of additional withdrawal fills her up very close to the top of the absolute lowest set of brackets available in her province. Every single dollar of this extra RRIF money she withdraws is taxed at roughly 20%. She will need about $20,000 of that total amount for her actual living expenses, but the remaining $10,000 should not simply be sitting around. It goes straight into her TFSA, assuming she has the room, which she does. She just moved $10,000 from a fully taxable account to a completely tax-free account at a highly favorable tax rate of about 20 cents on the dollar. If that same $10,000 had stayed sitting in her RRIF, only to eventually be drawn out either in her final tax return upon her passing, it would have been stacked on top of whatever else she had left in the entire account and very likely taxed at a rate of 40% or perhaps even higher. Instead, she chose to proactively pay 20 cents on the dollar today rather than paying 40 to 50 cents later. That single year's move alone saves approximately $2,000 to $3,000 in future taxes. If Gloria replicates this strategy for 15 years, she has effectively shifted $150,000 from her taxable RRIF to her tax-free TFSA, paying a total of roughly $30,000 in tax along the way, but saving thousands. If that $150,000 had stayed in her RRIF and was left for the final estate return, the tax bill would have been closer to $65,000 to $70,000. That's an impressive $35,000 to $40,000 in total tax savings over her retirement from this one single strategy. And perhaps best of all, her family receives the entire value of the TFSA completely tax-free. Now here is the psychological aspect that makes this strategy incredibly difficult for people to implement. During the years that Gloria is actively doing this, her immediate tax bill is higher than it strictly needs to be. She is proactively choosing to pay more taxes right now, and doing that feels absolutely wrong. Every instinct you have tells you to minimize your current tax liability. I have sat across from clients who look at me like I am taking crazy pills when I advise them to take more money from their RRIF than they actually need to spend. They ask, "Why would I pay tax when I don't have to?" And my answer is always precisely the same. You absolutely do have to pay this tax. The only real question you have control over is when you will pay it and how much it will cost you. Would you fundamentally rather pay 20% today while you can control the withdrawal rate, or pay 45% or more later when mandatory minimums or an estate situation forces your hand? Because later is coming, whether you plan for it or not. The key to implementing this yourself is to look at your total guaranteed taxable income, determine the top of your current tax bracket, and intentionally fill that gap by withdrawing the excess from your RRF and depositing it into your TFSA, moving money to a more favorable tax environment. That is the essence of bracket filling. Moving on to the second crucial move that most retirees miss entirely, which revolves around understanding the extreme power of the year immediately before your old age security, OAS, benefits begin. Most Canadians view OAS as simply a reliable benefit that automatically starts at age 65 and shows up every month. They do not proactively think about what happens to their overall tax picture and available bracket space in the year before it begins. This is a massive missed opportunity, because the year you turn 64 might actually be the most valuable tax planning window you will encounter in your entire retirement journey. When you are 64, if you have already retired and are strategically delaying your CPP benefits, you might have almost zero taxable income. You have no employment income, no CPP yet, no OAS yet, and perhaps only a small amount of investment income from a non-registered account. This means your entire basic personal amount, which is roughly $16,000, is sitting there, potentially completely unused. On top of that unused basic personal amount, you have a completely wide-open, full first tax bracket available to you. Once OAS starts at 65, and once CPP eventually starts, that low-rate tax space starts to shrink rapidly and permanently. You will have less and less room to implement the meltdown strategy with each passing year. Let's look at the numbers again. If 64-year-old Gloria is retired, has only $3,000 in taxable income, and her first bracket is open to $58,000. She has $55,000 she could potentially pull from her RRIF at a highly favorable blended rate of about 15%. Even if she only needs $25,000 for spending, pulling the full $55,000 and putting the $30,000 excess into her TFSA means she moved that money for 15 cents on the dollar. If that same $30,000 had stayed in her RRIF until she was 75 or 80, it would have been stacked on top of her CPP, OAS, and other income, likely incurring 30 to 40 cents on the dollar in tax, or potentially 50 cents or more at death. This single move could save $4,000 to $10,000 in future taxes. However, what most 64-year-olds do is nothing. They have almost no income, pay almost no tax, and feel that they are winning. But they aren't winning. They are wasting a finite opportunity. I've had this conversation dozens of times, and clients always ask why they should pay more tax when they are currently paying so little. The answer is precisely that. You are paying almost no tax because you have almost no income, and that empty, unutilized tax bracket represents a disappearing opportunity. The closer you get to 65, the more urgent utilizing this empty space becomes. If you are in your early 60s and retired, you must look at your taxable income right now. If it's low, the gap between your income and the top of the first bracket is your golden opportunity to shift money from your RRIF to your TFSA, and you must do it before that window narrows permanently. This leads us to our third major section, which highlights the role of your TFSA as your most valuable, flexible, and completely tax-free paycheck during your 80s. Most people mistakenly think of the TFSA primarily as a long-term investment or growth vehicle, or simply as a place to save cash. But in retirement, the TFSA's single greatest power isn't its potential for investment growth. It's its power for income replacement. It is the one unique account that truly allows you to retain ultimate control over your own taxable income during the precise years, your 70s and 80s, when you otherwise have the least control over anything else. Throughout those decades, your RRIF minimum withdrawal percentages are climbing relentlessly every single year, whether you actually need the money or not. Your CPP and OAS payments are fixed and increasing with inflation, meaning they are non-negotiable. If you also have a defined benefit pension, that is likely fixed as well. You have very little ability to reduce your taxable income at that stage. However, if you spent the previous 15 years diligently building your TFSA through this precise meltdown strategy, you could now have a large, flexible pool of capital that you can access without adding a single dollar of taxable income. If you suddenly need $15,000 for a significant home repair, you simply draw it from the TFSA with no tax implication, no government benefit clawback, and no jumping up to a higher tax bracket. If you want to help your grandchild with a down payment on a home, drawing from the TFSA is invisible to the Canada Revenue Agency. If you end up requiring care in a facility that charges based on your reported taxable income, every dollar sitting in your TFSA is income that they simply cannot see and cannot charge you for. Consider two alternative futures for Gloria. Gloria A, unfortunately, did not take advantage of any of these proactive strategies. By the time she is in her 80s, her TFSA has unfortunately been fully spent, but she still has a very large $200,000 remaining in her RRIF. As a result, she is now completely at the mercy of her RRIF, which is a financial trap. Every single dollar she might need above and beyond her minimums will come with a substantial tax bill. Any unexpected expense will likely push her into a higher tax bracket, potentially trigger more clawbacks, and worsen her situation. Conversely, Gloria B, on the other hand, might have slightly less money overall, but she has shifted all of that taxable RRIF value over to her tax-free TFSA over the years. Yes, she is sitting with a lower value of $150,000, but because every dollar of that is in the TFSA, it is all hers. She has total freedom, total control, and is not trapped. She can handle financial surprises, she can make decisions, she can truly enjoy her retirement. You must protect your future now by feeding your TFSA through your RRIF meltdown. You need to view every single dollar you move into the TFSA today as a dollar of unencumbered freedom in your 80s. This principle of active management is perhaps nowhere more critical than for single retirees, which is the focus of our fourth and final strategic point. The single person's RRIF countdown. Here is a massive problem. Practically all the mainstream withdrawal order advice you read or hear is fundamentally designed for married couples. They talk constantly about income splitting, spousal RRIF rollovers at death, having two sets of tax brackets, and utilizing two basic personal amounts. If you are married, the entire system gives you powerful tools to manage your collective tax bill across two people. However, if you are single, you don't have any of those options. And here is what absolutely nobody in the financial industry is telling you directly. The ultimate goal of your single-person RRIF meltdown strategy is fundamentally and drastically different from that of a couple. When a married person passes away, their RRIF rolls over to their surviving spouse completely tax-free. The surviving spouse absorbs that capital and can keep drawing from it at reasonable, albeit slightly higher, tax rates, and the total tax paid is effectively spread out over a few more decades. When a single person passes away, there is no rollover option. Whatever substantial amount is left remaining in your entire RRIF account gets added in its entirety to your final tax return, all of it in one single year, stacking on top of whatever other income you had already received in that year. If there is, for example, $250,000 left in your RRIF when you pass away, your estate is looking down the barrel of roughly $100,000 or more in combined federal and provincial taxes in that single year, on money that you spent your entire working life building up and protecting from tax, only to lose half of it at the finish line. So for a couple, the meltdown goal is to fill the brackets and keep things manageable across 2 lifetimes. For a single person, the goal is much different and much more urgent. The goal is to get that RRIF balance as close to zero as humanly possible before you die. That is a completely different target, and it requires a completely different plan and execution. Consider what this plan looks like for Brenda. At age 63, single, she has $320,000 in her RRIF and $55,000 in her TFSA. If Brenda follows the standard advice to keep income low, only take the minimum to protect the RRIF principal and let the RRIF grow. By the time she passes away, say at 87, she might still have $180,000 sitting in that RRIF. Her final tax return will face a $75,000 tax bill, while her TFSA might only have $20,000 left. My alternative plan for Brenda would look vastly different. I would proactively map out a 25-year RRIF drawdown plan with one primary goal: get that RRIF down to zero or as close as possible by her mid-80s. In her golden window from 63 to 65, she should pull perhaps $45,000 a year from the RRIF at only 15% tax, moving the $15,000 excess into her TFSA. From 65 to 70, with OAS added but CPP still delayed, she has room and pulls $35,000 a year, again moving excess to her TFSA. From 70 onward, with CPP started, her bracket space tightens, but her RRIF balance is already substantially reduced to perhaps $140,000 instead of $320,000. Her minimums are now much smaller, and her OAS clawback is not triggered. By age 82, her RRIF is down to maybe $30,000 or $40,000, while her TFSA has grown to a substantial $160,000. If Brenda passes away at 87, the tax on whatever minimal balance is left in the RRIF is almost negligible, maybe $8,000 instead of $75,000, and her entire TFSA transfers completely tax-free to her heirs. She has not just saved $65,000 more of her own money, she has saved her estate from a massive preventable tax bill. Implementing this alone is hard for single clients. They often voice a constant fear of running out of money. I assure them that the RRIF is not disappearing. It is simply moving to a better account. You are not spending your safety net. You are just placing it somewhere safer, somewhere it cannot be taxed when you need it or when you die. If you are a single Canadian retiree, you must sit down and map out your projected RRIF balance year by year from today until age 85 or 90. You must compare the projection of what it looks like if you only take the minimums versus what it looks like if you draw it down aggressively during your lower income years. The financial difference between those two projections is the massive amount of tax your estate will either unnecessarily pay to the government or will successfully keep for your beneficiaries. For most single Canadians I work with, this difference can be anywhere from $50,000 to $100,000. This is not some rounding error. It represents your children's inheritance, your lasting legacy, and a fundamental financial change that is entirely within your control right now. If you are single, the RRIF meltdown isn't simply about filing a lower bracket. It is a critical countdown clock to get that RRIF balance down, get the TFSA balance up, and to do it precisely while your current tax rates are strongly in your favor. This entire approach, from filling tax brackets and utilizing the 64-year-old tax window, to optimizing the TFSA for control in your 80s and managing the single person's RRIF countdown, is the core financial strategy that most Canadian retirees, unfortunately, never learn. But if carefully watching this detailed analysis has made you realize that you are not entirely sure how the rest of your own unique retirement is truly set up, whether your CPP timing is truly optimal, whether your RRIF conversion approach is costing you too much, or whether your overall estate plan has significant gaps, that is precisely the reason that I meticulously created this entire comprehensive analysis on achieving a successful retirement in Canada. For more detailed insights, continue learning and educating yourself about these critical strategies. At Smart Pension Canada, we are committed to providing you with the necessary tools and information to optimize your retirement and secure your financial future.